The take on the market today. Hi friends, welcome to F9. I'm Sunil Thakker. The classic balanced portfolio of 60% stocks and 40% bonds has rebounded from its worst year in more than a decade, but remains besieged by naysayers and doubters. While there are lessons to be learned from the portfolio's recent sharp stumble, valuations point to better times ahead for the old school portfolio. Future price to earnings ratio, that is the P ratios, are the consensus best guess for what company earnings will be in the future. It's a good way to capture the growth expectations that are priced into the market. Like any good crystal ball, however, it only offers hints at the future, never fully revealing what's to come. Nonetheless, lower future P ratios are generally better starting points than higher future P ratios. Bond investors are stereotyped as being more pessimistic than stock investors and are always focusing on what could go wrong. They are confused and have a paranoia that makes them calculate the lowest yield an investor can expect if other factors were to come into play. It's not a smart move to try market timing a core holding like the 60-40 portfolio and most investments. Keeping valuations in mind can help set expectations and shield investors from hurting their results by buying and selling at the wrong times. There's one thing investors can do to improve their odds of success with a 60-40 portfolio. Hold it longer. Rising interest rates continue to pose a near-term risk for the 60-40 portfolio, but it is designed to deliver over longer periods. Based on the most recent valuation, the portfolio looks slightly more expensive than the norm, but is not overpriced. So, investors should check expectations, but do not have to check out. In the past 10 years of the US stock market, the annualized returns of S&P 500 was 14.7% and the Dow Jones Industrial Average was 15.03%. And in India, in the past 10 years, mid-caps, that's the Nifty Mid-Cap 150, gave 18.5% annualized returns. During the same period, large caps, that's the Nifty 50, have 13.2% annualized returns, and the small caps, that's the Nifty Small Cap 250, gave 16.3% annualized returns. Over 1 year, there's about 1 in 5 chance of losing money. But over 15 years, the odds drop to less than 1%. There's no guarantee that a 1% chance of loss won't happen or won't be painful. But it confirms my recommendation to hold the portfolio for longer periods. This gives credence to the golden rule of 15 by 15 by 15, which is $15,000 for 15 years at 15% compounded to give you $10 million. Einstein said, compounding is the 8th wonder of the world. And Warren Buffett, at the ripe age of 92, still thinks only of the long term. So for those who do not invest directly into the market, continue doing so indirectly through SIPs and ETFs. The above is certainly comforting. But as the cliche goes, there are lies, damn lies, and statistics. And I could be wrong. If so, those investors have good reason to implement their future views. So do those who strongly believe that the 60-40 portfolio's recent gains are merely a mirage, the respite before resurgent inflation leads to a second downturn. I will certainly appreciate your comments. So what's the long-term view of the market? US manufacturing may be poised for an overall and a rebound with a potentially significant impact on the nation's overall economy. Companies now are taking steps to source more component parts and raw materials domestically that will eventually support full manufacturing in America. And the next big emerging story in the world is India. The International Monetary Fund, that is the IMF, raised its forecast for India, saying that the country's growth will remain strong in 2023 and 2024. According to IMF's October update of its World Economic Outlook, India's economy will grow 6.3% in 2023 and increase from an earlier forecast of 6.1%. As a cherry on the top of the cake, the Morgan Stanley report on India 2023 has predicted an economic boom for India, which will make it the third largest country in the world by the year 2027. The report predicted that the GDP could double from the current $3.5 trillion to over $7.5 trillion by 2031. So, there is no need to panic. Selling now will only add to the pain. If you can, along with cautious optimism, buy at dips and hold for the long term. To all my long-term investors, happy investing. And traders, please note, you are most welcome to share, subscribe, and give your valuable feedback in the comments. Stay inspired.